situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces,
yeah,
and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions. Where, for example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what what that is.
Well, when you think you've talked frequently about the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it, is we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index, and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the Treasury rate curve, we'll look to see significantly positive real rates across the curve, and you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation. And I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors on that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we'd estimate as the longer run neutral rate. Mm-hmm. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime. And what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. You know, having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system and the financial system generally. So that's how we would do it.
In the minutes of the last FOMC meeting, it said the staff had a forecast that does not, it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that how you look at it?
So I have resisted the temptation to handicap it.
Oh, go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or softish landing. I do believe that. And
the definition of a softish landing is what? Unemployment goes up a little, but we don't have a recession?
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You know, you can think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it. And I think the path is pretty clear. It's the labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I mean, I think that's very plausible. I don't want to be the handicapper on it. And of course, our job is to try to achieve that. And I think it's still achievable. Although, if you look at the history, it's not a likely outcome, but I would just say this is a different set of circumstances.
Well, you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or is it widened, or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what, 5-6 weeks ago. Yeah. I was asked the question, has it narrowed? Is it still possible, and has it narrowed? It's definitely still possible, and it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent and this, to have spread so broadly through the economy. And so to the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
In August 2020, you announced a new framework for monetary policy, the flexible average inflation targeting framework. And I wonder whether there's anything in that you think we should be rethinking now in light of the recent experience.
So we said we would do another framework review in 5 years. And so that would be to bear fruit in 25 or 26. So that's what we're going to do. We're going to stick to that. I think we need to see this through a full cycle. We need to see the other side of inflation and what the economy looks like after this historic episode to really make good judgments about that. I will say, though, that aside from the framework itself, we implemented it through guidance of various kinds. And we put in really strong guidance because there were a lot of doubters that we would ever achieve 2% inflation, if you remember. That was the main criticism. Little did we know. But one piece of guidance that we gave was, and I don't think this had anything to do with or much to do, let's say it that way, it didn't have much to do with all this inflation we're experiencing, but the one piece of guidance that we gave that I probably wouldn't do again is we said we wouldn't lift off until we saw both maximum employment and price stability. And I don't think I would do that again.
Because?
I think it limited, it's the tail risk. We tend as human beings to underestimate tail risk, and I think we didn't think. It seemed so unlikely. If you remember, 25 years of low inflation.
Right.
And many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most of them are questions I've already asked or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to give that person an opportunity to get an answer. What do you like to do in the morning before you start work?
Work. No, I'm a super early person, and I read a bunch of newspapers and drink my coffee in peace, and then that's what I do.
And now that you're chair, do you still ride your bike to the Fed?
Some. I ride down. Well, I won't tell you where I ride, but I do.
Yeah.
I ride.
The security guys thank you for that.
They're like, no. Yeah.
Okay, so here's the deal. We're going to take questions from the audience. You need to wait for a microphone to get to you because we have a lot of people online. You need to say who you are, and you need to remember that this is not an opportunity for you to make a speech or tell the Fed what it should do. It should be a question. It should be short, and questions end with a question mark. So come down here. Want somebody, Joe, and then Jonathan?
Thank you. Joe Beaulieu from Brevin Howard. So you've spoken both about risk management considerations and the inherent danger of inflation becoming entrenched. So I was wondering, how much do risk management considerations suggest a terminal rate higher than would normally be expected to achieve your policy goals?
So I think there are a number of dimensions, and it wouldn't necessarily one of them would be potentially a higher rate, but more I would think one risk management technique is to go slower, right? To go slower and feel your way a little bit to what we think is the right level. Another is to hold on longer at a high level, and not loosen policy too early. I don't want to over tighten. Certainly, my colleagues and I do not want to over tighten because I think that cutting rates is not something we want to do soon. So that's why we're slowing down and going to try to find our way to what that right level is. But theoretically, it's another dimension, but it's not. It wouldn't be my first choice.
Thanks, Jonathan.
Hi, thanks. Jonathan Pingle with UBS. So I had a question about the imbalance between labor supply and labor demand. One of the things that's a little obscured when we look at and discuss the labor force participation rate is there is a pronounced downward trend due to population aging. So when you think about realigning labor supply and labor demand, are FOMC officials hoping or expecting that participation really moved back up all the way to a pre-COVID peak? And related to that is, the follow-on question, how much of the realignment do you think needs to be done through restricting labor demand as opposed to the ability of supply to catch up?
So on labor force participation, I think it's useful to go back 10 years, and the forecast that mainstream labor economists had was that, and you're right, aging of the population leads to declining labor force participation. Notwithstanding that, labor force participation was in effect flat and a little bit up from 2013 to 2020, roughly. And that was because you had a strong, tight labor market. People were staying in the labor market longer than expected. That was really what it was. So our ability to predict is not perfect in this, except over long periods of time, you have an aging population, so you're probably going to have declining labor force participation. I don't think it's reasonable to expect that we get all the way back to where we were with labor force participation in 2020. It's 63.7, I guess, population adjusted. I don't see that, but I wouldn't rule it out, and we're nowhere near that now. We're 1.5 points below that now. So the real question is, do we expect to see big chunks of labor force participation? I got to say, this year we've seen, in the aggregate, not much, and it's been very disappointing and a little bit surprising. So that's part of the story. The other part, as I mentioned, is population. Is that the labor force, a big part of the shortfall in the labor force is actually population as well as participation.
So given population trends, given that there's still some workers are clearly anxious about going to work during COVID, and given that immigration is well below the levels that were projected before the pandemic, does most of the balancing have to come on the demand side?
Well, I think for now, we have to assume that. That's why I talked about, supply side policies on labor, but although they're not for us to recommend or to answer questions about.
Noted, please.
So yeah, the answer is yeah. That's what I kind of said that in my speech. We have to do what it takes to restore balance in the labor market to get back to 2% inflation. That's what we're doing. Really just by slowing job growth, rather than putting people out of work.
Joe Gagnon.
Thank you. Joe Gagnon, Peterson Institute. Chair Powell, back in 2018, you gave a speech questioning the role of the so-called star variables that the Fed uses to navigate. And there was this possibility raised that maybe unemployment could fall well below what the staff thought the natural rate U star was, then without causing inflation. But then COVID came and turned everything around. And as you just said, one interpretation of COVID is that U star went way up and we were on the wrong side of it, which is inflationary. My question is, going forward, is it likely, do you think it's likely that things could reverse as the dust settles from COVID and we could end up back in that world where maybe we're on the other side of U star, we don't know it, it's hard to tell? What lessons did you learn from that period that got forgotten because of COVID, perhaps?
Well, unemployment went below so what we write down and what the staff writes down is a longer run U star, longer run estimate of the natural rate of unemployment. I guess one thing I would say is that during the course of a long, relatively gradual, so we only have one experience, right, to generalize from, but what I learned from that experience was long, relatively slow, not super fast expansion. You really saw the natural rate of unemployment, the shorter term natural rate, come way down. We had 3.5% unemployment with really little sign. Wages were just getting up to that level of productivity and 2% inflation. So we could be back in that place. I think we could certainly be back in that place. But what we've seen, it's another N=1 situation with the pandemic. It's also unique. I would also point out, though, we did see the inflation we saw at the beginning. We did have natural rate of unemployment go up probably significantly. But the original inflation we saw was not to do with the Phillips curve, with the labor Phillips curve. It was not to do with that. It was to do with goods more.
So I think another way to frame Joe's question is, I think a lot of us thought that the lesson we learned when unemployment fell very far and we didn't get inflation, that maybe over time, before you were in charge, the Fed was erred on the side of being too tight, that it was too worried about the unemployment rate falling. And I think the concern is that, will we fight the last war? And because of this experience, the Fed will be reluctant to experiment with a low rate of unemployment in the future.
I'd love to have that problem again, if we can get back to,
Okay, so you got like 3 years left in your term. Do you think you can pull this off in the next 3 years so we can run the N=2 experiment?
Absolutely. Yeah.
Claudia Sam?
Claudia Sam Consulting. So the question I had is, we've had unexpectedly fast and large rate increases this year, and that has pushed up the dollar relative to basically any currency in the world. We've seen likely more financial market instabilities. So the Federal Reserve's dual mandate is for the United States, and yet are you worried that a severe global recession or financial market turmoil would come back to make it harder for us to achieve the U.S. dual mandate? Thanks.
So we do, of course, look at global developments. We have a domestic mandate, of course, as every central bank does. But in this world, global financial markets and the global economy really matter for us. So we monitor all that very carefully. We really think, and my colleagues and I really think, that the best thing we can do for ourselves and for the global economy is to get inflation under control as quickly as possible. We don't think the world's going to be a better place if we take our time and inflation becomes entrenched and then we have to go in later. The evidence is that the employment costs of bringing inflation down only rise with delay. So at the same time, we don't want to do any more than we have to do, but we feel like as a risk management matter, we needed to do what we did and feel like we're now in a place, again, as I said, where we can slow down and try to reach that ultimate level.
But how much do you worry about, I think what Claudia's question implies is, we do something with rates, other people are forced to do things with rates, and that ends up spilling back to us and makes it harder for you to do it. So you have to take that possibility into consideration.
We absolutely believe that we take that into consideration. The model's explicitly taken into consideration. Of course, they're not perfect. No one would say we do it perfectly, but I mean, we have a very large global model that we use for the global economy, and it absolutely takes into account what's happening with the real economy and monetary tightening and currency and all those things. It won't be perfect, but we do that. And we also sort of understand generally that there's a lot of research and things. People are talking about this a lot right now, that, maybe the whole is bigger than the sum of the parts when it comes to tightening. Maybe it is, maybe it isn't, but we're aware of the risk of that. But again, I come back to, look where we are. We've raised, 375 basis points. Markets are working. I think we're now in a position where we're in a place where we really can get inflation under control, and unemployment's at 3.7%. So I don't regret getting to where we are, and I think broadly the world will be better off if we can get this over quickly.
Thanks. Julia? Julia, stand up so the mic can find you. And can you bring a mic down here to Feroli?
Can I ask 2 questions?
If they're short.
Yeah, very short. So one question on the labor market is, how do you reconcile, the characterization of the labor market as very tight with the fact that wage growth isn't keeping up with inflation and the labor share of GDP really hasn't risen since 2020? And then second question is, how much credence or what kind of research do you rely on to think about the notion that a very tight labor market will lead firms to invest in and innovate and become more productive over time? Could that be a tailwind to productivity growth?
Okay, I wrote those down really fast. Now is the problem with reading my handwriting. So you asked about...
Well, the labor market is tight, but wages are not rising faster than inflation.
Okay.
And the labor share of GDP, which has been depressed for some time, hasn't really started to rise. So how do you put that into your thinking?
So naturally, we understand that real wages are not going up for most people. But to me, that isn't that's true, but it's not really dispositive. I think the issue really is that it's one of salience, really. So at what point do people start saying, I need higher wages because my real wages are going down. You're giving me these 6% wage increases, but inflation is 7.7%. I need more of that. So we don't really know when that point is. But when you get to that point, you're in serious trouble. And we don't think we're at that point, but it can't be that we can go on for 5 years at very high levels of inflation and that it doesn't work its way into the wage and price setting process pretty quickly. So that's a serious concern. So on the second question, yes, I think we're seeing that. You're seeing the service industries. You're going to see, this labor shortage that we have, as I mentioned, it doesn't look like it's going away anytime soon, and that's absolutely, I think, certain to lead to a lot of investment in technology and labor replacement technology where there isn't labor, and I think you'll see quite a bit of that, and could it be a dividend going down the road? I would think it'll have to be to provide the services that the public wants to buy.
Thanks, Mike Feroli, J.P. Morgan. So you spoke about going somewhat restrictive and then staying there for a long time. Why would you prefer that over a shock and awe approach that goes very restrictive but for a shorter period of time? And I ask that because there's some evidence that sacrifice ratios are lower in a more aggressive regime like that.
I think we've been pretty aggressive, I would say. No, I don't. I don't agree. I mean, we wouldn't, to just raise rates and try to crash the economy and then clean up afterward. I wouldn't take that approach at all. I think we're in a position where the right thing to do is to move really quickly as we have, and now slow down and get to that place where we think we need to be. And by the way, there's high uncertainty around that. We have a broad set of thoughts about where that destination might be, but we could be wrong. It can be higher than that, could even be lower than that. We'll have to see. But I think that's the right approach, and that's also the approach that it would allow us not to throw away the option value of upending a lot of lives, which we would do if we crashed the economy and we might get rid of inflation, but at very high human cost.
There's a question in the very back, a woman in front of the camera. Do you want to stand up? Thanks.
Thank you so much for seeing me in the back here. Nancy Marshall-Genzer from Marketplace. Just wondering, Chair Powell, is the Fed in danger of neglecting its maximum employment mandate? Is the maximum employment mandate taking a back seat to the stable prices or inflation mandate?
No, absolutely not. Absolutely not. The thing is this: without stable prices, we can't have maximum employment, and that's how I think about it, and I think my colleagues as well. In the sense that if you're constantly fighting off inflation and having these battles and having to raise rates, and it goes on for 5 or 10 years as it can, you're not going to have maximum employment. The situation we would love is to have another one of these very long expansions, and we've had 4 of them now in the last several decades. Really, when inflation was low after the 70s, we got out of the habit of these short inflation-driven business cycles, and we were able to reach, you saw where we were 3.5% unemployment. Those are really good for, very beneficial to our society to have these long expansions, and the benefits start to go to people at the lower end of the spectrum in the 7th or 8th year in the last cycle. So I think the two things go together. Right now, the labor market is incredibly strong. Again, before this thing, we've never had 1.7 job openings for every unemployed person. So this is a great labor market in that sense. It's too great in a way because it's going to be adding to inflation.
There's time for one more. In the back, the gentleman on the aisle. All right, 2 questions. 2 gentlemen on the aisle. Keep them short.
Thank you. I'm Orange Wang from South China Morning Post of Hong Kong. So I would just like to ask a question related with Chinese economy. So right now, a lot of analysts are arguing or believe that China's zero COVID policy is continuing to take a toll on the Chinese economy, but also likely to weigh on the global economy due to the size of China's market and its position in the global supply chain. So we're just wondering about what impact or how much impact do you accept that continuously slowing Chinese economy would have on the U.S. economy or the Fed's next interest rate moves? And is China's current economic situation a disinflationary factor or an inflationary factor to the U.S.? Thanks.
I guess I just say that to the extent China's having shutdowns in the parts of the country and the parts of the economy that are deeply connected to global supply chains, that's going to make those supply chains less efficient, less effective, and so that will have an effect on the prices of some of these goods that are manufactured or assembled in China. So it does have an implication for the U.S. It's hard to say how big that will be without knowing how persistent, how long these lockdowns take place for.
And the gentleman behind you.
Thank you. Evgeny Shego with Public Citizen. I was wondering how you think about the trade-off of restrictive policy and the supply constraints you mentioned. So in particularly when it has a negative effect, say, on housing production that makes it harder to meet housing demand, or on the congressional investment through the Inflation Reduction Act in climate change mitigation and in energy policy that will make energy cheaper long-term. How do you think about that trade-off?
Yeah, I don't think our restrictive policy would have much of an effect on the sort of climate mitigation investments you're talking about. In terms of housing, there are 2 things. One, there's sort of a longer run housing shortage that we have. But in the meantime, we had coming out of the pandemic, rates were very low. People wanted to buy houses. They wanted to get out of the cities and buy houses in the suburbs because of COVID. And so you really had a housing bubble. You had housing prices going up at very unsustainable levels and overheating and that kind of thing. So now the housing market's going to go through the other side of that and hopefully come out in a better place between supply and demand. But none of this really affects the longer run issue, which is that we've got a built up country and it's hard to get
things that's happened. I'd like it for all of you to stay in your seats for a minute till the chairman can leave safely. And if you have paper at the coffee cups or something, take them to the back of the room and dispose of them. So thank you very much.
All right, everybody, you have been listening to Jay Powell, of course, there with David Wessel, there at Brookings, and really some great commentary that has certainly impacted the financial markets. And I've got to say a welcome, good afternoon, everybody. Carol Master, Tim Stenovic. We're not in New York, we're on the West Coast. We've got a special broadcast coming up tomorrow. We are, though, on YouTube and also on Bloomberg Quick Take. But no doubt about it, Tim, this has been the key focal point, if you will, for the week so far. We've got jobs coming on Friday, but we wanted to see how Jay Powell, chair of the Federal Reserve, the most important voice when it comes to monetary policy, what he had to say and how that impacted the markets, and he certainly did.
And it did impact the markets. We're seeing the S&P 500 up close to 2% as we speak. A big word here, Carol, signaling a downshift. That is the big takeaway here.
Do I read that as a pivot? I do read
Do you read that as a pivot?
Well,
it's not a pivot to cutting rates, and he said he doesn't want to cut rates anytime soon.
No.
But going from 75 to 50 basis points, that's a big deal, and the equity markets are loving it.
I thought what was really interesting, too, is what he had to say about basically want rates set to rise further and stay at restrictive levels for some time. He did talk about not wanting to overshoot in terms of monetary policy. That was really important. He talked about the ability to still get to kind of a soft slowdown, if you will, a soft landing. So the market's certainly reading that well. The shorter term of the yield curve also reading that, because you've seen certainly reaction along the yield curve, and particularly in that 2-year note, which is most sensitive to Fed policy.
He also said that substantially more evidence of easing inflation is needed. Treasuries have trimmed losses. We talked about the S&P 500 ticking higher. The NASDAQ 100 absolutely on a surge as well.
All right, you are listening to Bloomberg Business Week live from our Bloomberg 960 studio and bureau in San Francisco.
Bloomberg Business Week is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more.
All right, we've got our team back in New York. We're in San Francisco. Now we're going to head to our bureau in Atlanta, because we've got one of the smart voices when it comes to Jay Powell and the Federal Reserve. Chief Jay Powell, as you know, speaking at Brookings, taking questions. So let's bring in Bloomberg News economic reporter Steve Matthews. He is in our Atlanta bureau. So, Steve, good to have you here. Let's talk about Jay Powell. What was the most important thing he said today, whether it was in his speech or in his Q&A?
Well, I think a couple of things. I mean, what the markets took away from this was obviously kind of locked in on December. You're going to get a 50 basis point hike. He didn't say that specifically, but if you read between the lines, he all but said that, yes, we're going to get 50. It's time to start slowing the pace of rate hikes. But he also said, you know, he repeated, and these are themes from the past press conference at the November meeting, that you could have rates that are higher than what they had been expecting before. So you could have in the dot plot in December rates moving up a bit from where they were in September. To me, the thing that jumped out was the way he was framing the fight against inflation. He said there are basically three types of inflation. You have goods inflation, where there's been a lot of progress. There was COVID disruption. Now that is easing. You have housing inflation, and you know that's going to continue. But if you look at new leases, that they've already started to come down. So was a lot of optimism there. And then the third area was services inflation, and that was the area where there was, you know, a very uncertain outlook that whether things are going to get better or not. And that often was, you know, that was where it was talking about the labor market. There being too tight labor market, and that contributing to wage pressures and inflation.
Well, that's exactly where I want to go, Steve, because something that stuck out to me from Powell's comments was what he said about the labor market, the idea that immigration is well below pre-pandemic levels. We still got workers on the sidelines due to COVID. And then there was this, millions of Americans who left the workforce early during the pandemic, these so-called pandemic-era retirements. What stuck out to you from the perspective of the supply side here? Because it seems like he needs to bring down demand rather than increase supply when it comes to labor, because that's just not happening.
Yeah, that was really fascinating because he was saying if you look at where the Congressional Budget Office was projecting the size of the labor force before the COVID pandemic, that where they are right now is several million jobs short of where they were expected to be. And there are lots of reasons for that. The early retirements was one, the amount of COVID deaths and long COVID was another area. But that, and immigration, as you point out, has been disappointing. And he was kind of called on Congress and fiscal policymakers to do something. He said, we can affect the demand, we can't affect labor supply. And I'm not going to endorse any specific idea, but it's something that would really help the economy if fiscal policymakers would address the supply of labor. So, you know, we'll see if that happens.
Steve, you and I have been around the block a few times. Tim has too, a little bit.
A little bit.
But I do think the immigration story is something we've talked about for years in terms of, you know, change it, make it legal, bring them into the economy. There are a lot of jobs that immigrants coming into the United States would love to have that we're not able to fill at this point. So, like, it's been an old thing, but it requires legislation and policy, and I don't know if we're going to get that.
Yeah, you know, we all have been around for quite a long time because this has been a constant theme. I mean, I remember Ben Bernanke talking about it, and the Richard Fisher, the former Dallas Fed president, made controversial remarks, basically calling for more immigration, and clearly there are jobs that, you know, are going unfilled because they're not being filled by American workers. Americans don't want these particular jobs or are not skilled for them. And, you know, why we're not bringing more people in, it's just, it's not a mystery. It's because Congress has you know, decided not to do anything about it. And right now it's just, there's just continuing debate.
All right, so I know it's like, you know, what have you done for me today, or what have you done for me lately? We got through Jay Powell, very important. We saw the markets react. How important is Friday's jobs report based on what we heard from Jay Powell today?
I think it is important, and it's not important for the December rate hike. It's really now they're setting expectations for what happens in February. The next big debate you're going to hear at the Fed is not about December. That's pretty much a done deal, absent there being some shock. But it's about, do you do 50 basis points in February or do you do 25? And, you know, if you do 25, then that kind of sets at least the possibility that you could pause for a while. Or do another 25. So, you know, the next debate is going to be very much about the early February meeting.
All right, I got to dig into something you said. Pause for a while. It makes me think of what Jay Powell said, you know, staying at restrictive levels for some time. And the way he ended his speech, we still have more work to do. What does sometime mean?
Yeah, that's a really good question, because it's like they are setting up the idea that rate hikes are going to slow, but they're going to continue. And what's important is how high do they go and for how long? And they're kind of trying to set the narrative that it's going to be higher for longer, but they're not really defining that. But, you know, you will get some definition in the December dot plot, which will suggest that they plan to hold rates very high for at least all of 2023. So I think that is how they are looking at it.
A difference to what Gina Martin Adams told us yesterday, where she thinks that they'll see a cut of 50 basis points due to a recession in 2023, Carol.
Yeah, no, that's interesting. So where do we go with that, Steve? What are you hearing about in terms of, he was asked about certainly the economic outlook and recession. He seems to believe that he can still get a soft landing. So how do you think about it in the reporting that you are doing on the Fed?
Well, it's interesting they're talking about a soft landing because we're still having 3.7% unemployment rate, which is a very tight labor market. If you look at GDP now, the Atlanta Fed's GDP tracker, it's tracking at over 4% for the fourth quarter. It was interesting. The Beige Book came out today as well, and it was pointing toward fairly, you know, dismal growth in the most recent period, but that's not what the GDP trackers are showing. So, I mean, I think the case for a soft landing is there's so much momentum right now. The labor market can take some hits and will still continue to grow. and there's so much excess cash on households' balance sheets, still from the COVID cutbacks and from stimulus, and on state and local governments, that there's reason to believe that there's going to be a lot of momentum into 2023.
Hey, 45 seconds, Steve, left with you. What economic data have we gotten recently that is not working in the Fed's favor? Because JOLTS certainly is, and then a slowdown in job gains on Friday will work in its favor. But what hasn't worked in its favor?
That's an interesting question. I mean, I would say really the big thing is the headline inflation numbers have not come down. They continue to be disappointing. You've had, as you pointed out, one good month. But you're still seeing much higher inflation, and while jobs are showing some improvement in moderation, it's still running, twice as high as the payrolls are running twice as high as the Fed would like.
Yeah, and the Fed lucky that at least the labor market has held on to strength that gives them still some room to work on those inflation numbers. Steve Matthews, thank you so much as always. He's economics reporter at Bloomberg News, joining us from our bureau in Atlanta.
All right, from Atlanta to Washington, D.C. we go for world and national news with Nancy Lyons standing by. Hey there, Nance.
Thanks, Tim. Congressman Hakeem Jeffries has been unanimously elected leader of House Democrats. Bloomberg Government's Emily Wilkins has more on its significance.
Today, with this election, he is the first Black member to lead one of the major parties in Congress. So certainly, it is a historic day.
Bloomberg Government's Emily Wilkins. Secretary of State Antony Blinken has been meeting with NATO officials in Bucharest to discuss additional military support for Ukraine. He says the Russians are destroying Ukraine's infrastructure, which hurts civilians.
There needs to be an understanding of the brutalization of the country that is quite simply barbaric.
Blinken says Russia's actions cannot be normalized. France's President Emmanuel Macron is now in the U.S. for the first White House state visit in more than 3 years. He comes here, though, with a bone to pick with the U.S. Bloomberg Washington correspondent Anne-Marie Hordern says it has to do with the Inflation Reduction Act that Macron views as protectionist.
Macron has called it unfriendly policies about the Inflation Reduction Act and the subsidies this would be for U.S. companies. And his finance minister, Bruno Le Maire, went even further, equating it to what China does. So this is clearly going to be brought up.
Bloomberg's Anne-Marie Hordern. Tomorrow, the Bidens will host a state dinner for the Macrons. At the World Cup, Tunisia beat France. Australia defeated Denmark. No score yet in the game between Argentina and Poland, and in the game pitting Saudi Arabia and Mexico. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Master along with Tim Stenovic. We're live in our 960 studio out in San Francisco, on YouTube, on Bloomberg Quick Take. This story on the Bloomberg, not surprised. We've all been waiting for kind of as technology scales back in terms of firing workers, hiring less, just retrenching. You do wonder about all the office space that they've been consuming. And this one with Meta and Hudson Yards speaks right to that story.
And also think about what we've been talking about for the day, Carol, Jay Powell, and to what extent this actually plays into what he wants to see, the labor market actually loosening as a result of some of the layoffs that we've seen. How is this playing out in commercial real estate? Well, let's look no further than Meta Platforms. The company is reducing its New York City Hudson Yards space in a cost-cutting pivot. It's seeking to slash expenses and cull its workforce. Meta will return its space at 30 and 55 Hudson Yards to landlord-related companies, this according to people familiar of the plans, who asked not to be named because the matter, Carol, is private.
All right, so let's get through some numbers. Meta, keep in mind, leases more than 250,000 square feet across the two towers. They have declined, apparently, the option to renew that lease, which runs through 2024, according to those people in the know. Back in 2019, you might recall that Meta came out and said it agreed to rent more than 1.5 million square feet spread among 3 towers at Hudson Yards. Most of the space is at the 3rd building, 50 Hudson Yards. Meta is subleasing a small amount of space at that tower, according to its spokesperson. But again, We know that Bloomberg reported back over the summer that the company halted plans to further build out its offices at 50 Hudson Yards while it evaluates its real estate and its footprint, New York real estate footprint here, which includes about 730,000 square feet at the redeveloped Farley building across from Penn Station.
Yeah,
I mean,
that's a huge
space.
building. Exactly. The company did say, we quote, remain firmly committed to New York City as evidenced by the opening of the Farley building, further anchoring our local footprint. We also look forward to opening 50 Hudson Yards, which is estimated to be complete next year. That's Meta spokesperson Tracy Clayton.
But bottom line, watch commercial real estate, because tech has been a real driver in terms of picking up a lot of space, especially in New York City. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, and NASDAQ are all rallying. Stocks advanced after Jay Powell signaled a likely slowdown in the pace of tightening as early as December, while indicating more hikes will be needed to curb inflation.
The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level.
Powell's remarks carried live here on Bloomberg Radio. The 10-year right now, 3.69%, with the 2-year, 4.40%. S&P up 68, a gain of 1.7%. The Dow up 312 now, up 0.9%. NASDAQ up 311, a gain of 2.8%. Again, we've got spot gold advancing by 1%, $17.67 the ounce. West Texas Intermediate crude up 3%, $80.51 a barrel on WTI. Bitcoin up 3.5%, back above 17,028 right now on Bitcoin. Again, recapping, stocks rally after Jay Powell signals a likely slowdown in the pace of tightening as early as next month. 10-year yield 3.69%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this, I'm going to call it a Fed Wednesday because there's a lot going on. Certainly watching Jay Powell. We do want to get, though, to the cover of Bloomberg Business Week, which also happens to be this week's Bloomberg Big Take, or I should say today's Bloomberg Big Take. And to say it's a troubling story is certainly an understatement. The story, Tim, about TikTok, its viral challenges that children are actually dying from.
With more, we're joined by Bloomberg Business Week editor Joel Weber, who joins us on the Access line from Brooklyn, New York. Also with us is Bloomberg News investigative reporter Olivia Carville. She's with us from the Bloomberg Interactive Brokers studio in Manhattan. Joel, I want to start with you. The blackout challenge, it's something that children are dying from. The question Olivia tried to answer here is, why isn't the world's most popular app, we're talking TikTok here, doing more to protect them?
Yeah, so Blackout Challenge has been this viral sensation, really, that it's taken off on social media. And, you know, TikTok is not the only platform where it's been a thing, but what makes TikTok and the story really troubling is the algorithm that has really turned TikTok into the world's most popular app is incredibly very, very powerful. And it's so good at servicing content. But TikTok itself, extremely popular with young kids, but has no way of determining whether or not a kid is actually old enough to be using the app. And that's led to some really, really frightening situations. And personally, it's one of these stories, after I read it, I took away my son's devices and was like, you will never see the internet ever again. And
That's how I feel every day.
I say that lighthearted, but for real, like, this is one of these things that everyone just assumes that you know, the kids are not going to find themselves in places that they're not supposed to be, and just truly harrowing how scary some of these corners can become. Olivia, bring us into how you went about reporting this story, because it really involves some tragic elements.
Yeah, it does. I started reporting this piece by trying to get a sense of what happens inside TikTok after a child dies participating in an online challenge, and maybe there's been a headline in some local news reports connecting TikTok to that death. How does the company respond, and what happens internally? And the way to answer that question was to try and build sources on their trust and safety team. This is the team that is built within TikTok to handle the worst case scenarios. These are the fixers of the internet, the people who come in and clean up the mess, protect the company's reputation, but also try and protect users. And I spoke to more than 24 current and former trust and safety insiders to get a sense of what happens at TikTok in the aftermath of a really tragic incident like this. And that's how we were able to tell this story, is really through the lens of that trust and safety team.
Well, speaking of the tragic side of this, your piece starts out with just the tragic story of Ariane Arroyo. Can you share her story and what her family has gone through?
Ariane was a 9-year-old girl. She lived down in Milwaukee, Wisconsin, and she loved TikTok. You know, this is the most popular app in the world, and it is hard to deny the success of this company. 70% of teenagers in America are using TikTok, chat, YouTube, Twitter. So Ariane, like most kids, fell in love with TikTok, and she was using the platform on a daily basis, and she really enjoyed participating in the trending challenges. She would do things like hold water in her mouth until you start giggling, really kind of harmless, fun, joking challenges. But in February of last year, she attempted the blackout challenge, which is where children try and choke themselves with household objects until they black out, and then film the adrenaline rush or the high they get regaining consciousness. But at the age of 9, Ariane unfortunately was unable to help herself or to save herself. She'd choked herself with a metal dog leash, and she tragically died.
So Olivia, obviously TikTok is aware that there's a challenge here and that these have happened. There's been lawsuits. What does the company have to say about it, and what's their official response, and then what are others saying about that response?
Yeah, I mean, these dangerous challenges bounce across platforms. They exist on TikTok, but they exist on all the others as well. And users actually try and sidestep safety restrictions by doing things like misspelling keywords. So rather than writing blackout challenge, which has been banned on TikTok, they'll write blackout with a 0 and try and get around the artificial intelligence or the systems that have been set up to try and protect kids. So TikTok really doesn't want this content on its platform. It's done what it can to train its moderators to take down any content relating to the blackout challenge, and it also prevents anyone from being able to search for blackout challenge related content in the app. And it set those features in place, those safety restrictions in place at the start of last year after the first 10-year-old girl died attempting this particular challenge. But unfortunately, kids are smart and they know how to get around these safety restrictions, and they're doing that. And that means that the challenge is continuing to spread across social media platforms. And the most recent cases that we could find of deaths associated to the blackout challenge was August of this year. So despite all of those safety features being implemented, the deaths have kept happening.
Olivia, I have to say, about a million questions come to mind. The responsibility of the company, making sure kids aren't on this, platform and having access to content that they shouldn't have. And where are the moderators, like, watching all of this? Where are regulators? So where do you think we need to go from here to get on top of this?
Well, that question of age verification is like the elephant in the room. This is one of the hardest things for these social media platforms to do. How can you tell the exact age of the person who is on the app, using that device? Yeah. And don't forget that children's content is allowed on TikTok. You can film your children or your siblings who are under the age of 13 and post about it. Every social media platform in the US, at least, has a rule that says you have to be over the age of 13 to use the product. They call it within the industry the age gate, and it's very hard to enforce that. So these companies are trying to find ways around it, but this is one of the biggest challenges that social media platforms face.
An incredible story.
Big thank you to Olivia Carville and Joel Weber. Olivia's story, it's the cover of the new issue of Businessweek magazine. It's out later this week. It's also today's Bloomberg Big Take. Check out the Big Take podcast at Bloomberg.com or wherever you get your podcasts. And don't miss the Big Take on Bloomberg Radio, weeknights at 11 p.m. Wall Street time.
This is Bloomberg.
close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes to go here in the trading session. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Master and Tim Stenovic on the road. And we welcome our audiences across Bloomberg Television and Radio, as well as on YouTube and Quick Take. While you guys were flying out there to the West Coast, a lot going on over here on the East Coast. I don't know if you heard, Carol, but the head of the Federal Reserve actually spoke a little bit earlier today. And I guess overall, the market liked what they heard. Stocks right now pretty much at the highs of the day. The NASDAQ up 3%, Carol.
God, I got to feel like, Romaine, the Powell trade is on, because we really saw negativity certainly on the equity side of things, and things turned around on those Powell comments. One group, though, and I know I always go there, but it was outperformance from the get-go. And again,
what are you going to do? Wait, let me guess. Chinese stocks.
Well, hey, listen, Powell was asked about the Chinese economy and the impact it could have on the U.S. economy. So look at the NASDAQ Golden Dragon China Index, up another 9%. Guys, it's up about 16% in the past 3 days alone. Baidu up 8%. JD.com up more than 8%. Pinduoduo up more than 5.5%. Again, expectations of loosening restrictions in the Chinese country and then ultimately the economy, and that could be good for global growth going forward. But I got to just say, outperformance continues.
Yeah, and what a month for those stocks. I mean, I'm thinking big picture as well here. Looking at the S&P 500, we only have 58 stocks lower, 444 are higher in the index. To call this thing broad-based would certainly be an understatement. But Romaine, you hit the tech stocks earlier, and you talked about outperformance there. In the NASDAQ 100, we only see 5 stocks in the red right now, 95 in the green, higher on these comments from Jay Powell.
And that's quite a turnaround from where we were earlier. Remember, stocks pretty much opened flat, and they really went nowhere until right around 1:30 p.m. when he began to speak and really accelerated around 2 p.m. The NASDAQ 100 right now up more than 3% here on the day. The S&P up about 2% here. The Dow Jones Industrial Average up about 1%, and the Russell up about 1.6%. More importantly, though, I think here is the idea that all of these major indices right now, retest, with maybe the exception of the NASDAQ, retesting that 200-day moving average, particularly with the Russell, the Dow Transports, and now the S&P just a few ticks away from its 200-day moving average as well.
That's a lot of green arrows there, so I'm going to give you some more green arrows. When you break it down by industry group, all 11 groups in the S&P 500 are in the green right now. The worst performers are energy stocks, and they're up by 0.4%. If you break it down into 24 groups, again, every single group in the S&P 500 is higher. Banks and energy, the laggards there are gaining only 0.25% and 0.5%. It really comes down to this idea that, perhaps it's month end, and for a lot of mutual funds, it's also the fiscal year end. So Dave Lutz of Jones Trading had reminded us that there might be some window dressing taking place too.
A little bit of window dressing, but this is a pretty spectacular month across the board, particularly given the big sell-off that we had, remember, back in September. As far as some of the individual movers on the day, keep an eye on the bank stocks and some of the other rate-sensitive sectors. Rates moving lower here on the day. JP Morgan Chase slowed down on the day by about 0.1%. Vornado and a lot of the real estate companies also in the red, though we should point out they were much deeper in the red earlier in the day, so pairing some of those losses. Exelon and the utilities rallying up about 3%, and big tech really getting its groove back. In fact, a lot of those higher valuation companies rallying. Apple shares up about 3.5%. I do want to bring your attention, though, back to the macro economy, and you talk about what Jay Powell talked about, and there was really a big discussion here about inflation, particularly when it comes to core PCE estimates. We get a monthly update of that tomorrow, and those estimates going into 2023, they remain, well, elevated, 3.5% going into 2023. And here's the conundrum, though. The 2023 GDP estimate in the market, 0.4% here, a huge divergence here between inflation and GDP estimates, and that's something that Jay Powell is going to have to confront as they get into 2023 and try to maintain that higher level of rates for longer.
Yeah, that's what makes it so tricky for the Federal Reserve and Jay Powell in particular. And of course, we heard from him. This was a key focal point for all investors this week. We heard from him, the Q&A, very important. And I got to say, guys, when Fed Chair Jay Powell spoke at Brookings, he didn't say pivot, but he did talk about moderation. Check it out.
The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation.
And of course, that voice is Jay Powell, chairman of the Federal Reserve. So again, we're not getting necessarily a pivot, but he talked about moderating maybe the pace of those rate increases, but then also talked about maybe staying, guys, right, at a higher level for longer.
The question is how high and how long? And I know I sound like a broken record there. And there will be a little bit, some answers there, Romaine, because we'll get an updated summary of economic projections, a dot plot at the next Federal Reserve meeting in mid-December. So we'll have a better idea of, what members of the Federal Reserve think based on, how high and how long.
I think it's interesting you played that clip out of that, because I thought it was interesting that obviously the market reaction seems to be more focused on the idea of a downshift in December and kind of ignoring the other part of that comment, which is that don't expect, like you said, a pivot. Don't expect anything to come down. But more importantly, the idea that he seemed like he didn't really know how long they would have to keep rates high, but he made it clear they're going to be there for a while.
He wanted to keep his options open, and he definitely made clear that cutting rates is not something we want to do. So that's about as far as he said on the pivot. But I go back to what Annetta Markowski of Jefferies was telling us earlier, Romaine, which is that heading into this speech, the market was concerned that he might be more hawkish. He might indicate that the terminal rate might need to be higher. The fact that he didn't say that explicitly was a relief.
I thought it was interesting, though, how much he really laid out the case with regards to the inflation numbers. He talked about that October CPI report, and then, of course, talked about the PCE numbers that they pay closer attention to. And he did make a pretty compelling case that there is significant softness, if you will, or at least enough of a trend that maybe there's an argument to be made for slowing down.
I thought it was also interesting that he said, basically, we don't want to overdo it. He said, I think we've been pretty aggressive, don't want to overdo it, don't want to crash the economy. So he's certainly sensitive to it. And if you look at what bond traders are doing, right, they're cutting their expectations for how high Fed rates will go, especially when it comes to that key overnight rate. They're talking about now below 5%. So it does feel like everything's been scaled back a little bit.
I really homed in on his comments on the labor force, on his comments on, supply side versus demand side here. And his, not really thinly veiled message to policymakers that we need to see some changes when it comes to policy in order to get more workers from the sidelines. And, even dare I say, make immigration in this country easier in order to get people to take jobs that, are open right now and available.
It all comes down to what's going to happen in 2023, and there's really no visibility on that just yet. The Fed is looking at the data like everyone else, but worth mentioning here, according to Bloomberg Economics, that the composition of the Fed voting committee will change next year. There's going to be more doves. They'll make up half of the voting committee. Yeah. That could change communication and make it more of a debate among Fed officials themselves.
Well, but going back to the labor market, too, I mean, we talked a lot about retirement and how that's kind of skewing labor force participation and one of the reasons why you still see persistent job openings. But when you get into 2023, and to your point, Scarlett, here, what's the debate? I mean, unless you can fill that hole, unless you can sort of find some way to sort of plug that gap, they're in the same position then as they are now.
Pandemic-era retirements, still talking about those.
Whatever
and the way that permanently shifted.
Yeah, what
they left the labor force during the pandemic. I don't know. Do they ever come back to work?
I don't know. I mean, I feel like the immigration argument has been, go back to Ben Bernanke. He also talked about the importance of bringing maybe immigrants to help fill some of those jobs that are out there.
So with the divided Congress.
Yeah. That is a good point,
I know,
Scarlett.
exactly, right? All right, guys, we're going to come back, continue our conversation. TV, radio, quick take, and YouTube. We'll count you down on this Wednesday.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got the Dow, the S&P, and NASDAQ all trading at session highs right now. A Fed Wednesday. Stocks climbed after Jay Powell signaled a likely slowdown in the pace of tightening as early as December, while indicating more hikes will be needed to curb inflation. Powell's remarks were carried right here on Bloomberg Radio, and with more on what he had to say, here's Bloomberg's Vinny Del Giudice.
Powell indicated officials will throttle back the Fed's most aggressive assault on inflation since the 1980s, maybe in just a couple of weeks. At the same time, Powell stressed the Fed's war on inflation is far from over and that interest rates will still go up and stay high until there's evidence inflation is whipped. Fed officials next meet in mid-December. We could see a half-point increase, smaller than the past few months' three-quarter-point jumps. Vinny Del Giudice, Bloomberg Radio.
So the Dow now up by 450 points, up 1.4%. The S&P up 2.2%. NASDAQ up now by 3.3%. 10-year yield 3.68%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
From the Bloomberg 99.1 studio in Washington, I'm Nancy Lyons. Here are some of the day's top headlines. The House is moving to block a nationwide rail strike that could deal a major blow to the economy.
On this vote, the yeas are 290, the nays are 137. The joint resolution is passed.
The House also passed a separate measure that includes 7 paid sick days for railroad employees, which has been a key sticking point with workers. Both of the measures now go to the Senate for consideration ahead of the December 9th strike deadline. Well, the torch is being passed by House Democrats. Today, Hakeem Jeffries was unanimously elected to serve as the party's leader in that chamber, taking over the job that's been held by Nancy Pelosi for 2 decades.
It's an honor to stand before you today as the incoming House Democratic leader for the 118th Congress.
In addition to Jeffries, who represents parts of Brooklyn, House Democrats also united around Congressman Pete Aguilar of California to be chair of the House Democratic Caucus and backed Congresswoman Catherine Clark of Massachusetts to be minority whip. Christy McVie, who was a soulful singer and songwriter with Fleetwood Mac, has died. Christy McVie was 79. The band confirmed her death on social media, saying, quote, "There are no words to describe our sadness." At the World Cup, Tunisia took down France. Australia beat Denmark. Argentina leads Poland 1-0. No score yet in the game between Saudi Arabia and Mexico. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Nancy Lyons in D.C. with World and National News. I just heard about that Christine McVie.
I know.
Wow. Iconic band.
It is, and I feel like, we get to a point as we age where more and more people who we grew up listening to, who we grew up with, and look, she was, older than I was, but
older than me.
They start to pass.
Yeah. I mean, kind of cultural fabric, right, that we grow up with, or, that for me, music from my older siblings or parents or whatever, right? All right, so we are focused on Jay Powell today, understandably, and looking at, we had some mortgage data come out, some weaker housing data, pending sales data, and this story certainly plays into what is going on with the housing market at this point. We're talking about Starwood Capital. They're backed home lender reverse mortgage funding, filing for Chapter 11 bankruptcy, so the latest company to really succumb amid that rapid run-up that we've seen in mortgage rates, although they are starting to come down.
They are, but still high by, recent historical standards, right? 6.5% roughly is higher than what we've seen over the last 15 years. The company, the Reverse Mortgage Funding LLC, it makes reverse mortgages, as its name would imply. It listed assets and liabilities of at least $10 billion each in its bankruptcy petition. Chapter 11 allows companies to keep operating while they work on a plan to repay creditors. We should remind our listeners and viewers that reverse mortgages are a type of home loan geared towards seniors. What they do is they allow borrowers to convert equity in their homes into cash without needing to sell or pay more monthly bills.
Right, and you know the story here, right? Tim and I talk about it all the time, Tim. We talk about, this massive slowdown in the mortgage industry business as those sky-high rates deter new borrowers. Many homeowners locked in low rates during the last 2 years, and now they're reluctant to give them up. And this is the predicament that if you are in a home with a very low mortgage, you're probably going to stay put because you don't want to sell into a market where we're starting to see some price declines, a higher rate market. It's going to cost you more to refinance or go into a new home. And so that's kind of where we are.
Maybe we'll see prices come down as a result. We already have in some markets across the country. I'd say the only caveat to that, Carol, is if somebody outgrows their home because of new family members coming.
Sounds like you know from personal experience.
That's how I'm thinking about it.
All right, you're listening and watching Bloomberg Business Week. Carol Massar, Tim Stanovic. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Powell speaks stock surge. We've now got a 512-point gain for the Dow. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. It's all about Jerome Powell today, who said the time for moderating the pace of hikes may come as soon as December. Dow's now up 522 points. S&P's gained 95, while the NASDAQ is up by 3.5%. The U.S. 10-year yield falls to 3.69%. Gold is higher by 19. Oil is climbing. And Bitcoin is up by 3.5%. Among the main 11 S&P sectors, all are trading in the green, led by telecom and tech. And leaders to the upside in the Dow, Microsoft, Salesforce, and Apple. Modest losses in 3M and Walmart. In deal news, Reuters said that GE and L3 Harris, as well as others, are vying for Aerojet. And in other news, Zuckerberg says he's completely optimistic on his 5 to 10-year time horizon. After earnings, CrowdStrike fell as much as 21%. And wrapping things up, Snowflake, Splunk, and Salesforce all report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill, and to hear live breaking news over your Bloomberg type squawk. SQUA on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it, Charlie. Thank you so much. Charlie Pellet back there at Bloomberg headquarters in New York City. Carol Master, Tim Stenovic, we're live on the West Coast at our 960 studio and bureau in San Francisco. So a sign of our times as global central bankers raise rates, although I do wonder if we're recalculating a little bit off of Jay Powell today. Global debt costs, so no doubt about it, they are soaring. And a story in the new issue of Bloomberg Business Week by our Liz McCormick breaks down why and where it will be felt the most. This is an important story in terms of what's going on in the financial markets today.
It certainly is, and that's why we're bringing in Liz McCormick. She is chief correspondent for global macro markets for Bloomberg News. She joins us on the phone from New York City. As you mentioned, Carol, this story in the new issue of Business Week magazine. Liz McCormick, where is this going to be felt the most? Global debt costs are soaring.
Yeah, and like Carol says, we got a good vibe today. People like what Powell had to say. But we have to think about where we've come from. Nearly zero rates around the globe. Some were negative, right? And now they're up several hundred basis points. So, you know, we did kind of a deep dive on, like, who's feeling this the most, right? And you have households. Now, certain countries, like the U.S., kind of who got burned in the GFC crisis, doesn't have as much floating rate debt, but other countries do, like Canada, Australia, even South Korea. So we know how that works, right? You have a floating rate loan, and when these rates are going up, you're seeing your costs go up every month, you know? So that's painful. And we have even some nations, especially developing countries, which I know you guys have talked about before, the higher rates affect them. There's a lot more debt, too, right? Which we needed a lot of debt to get us, you know, out of the crisis. But there's just a lot of debt to service. So especially the developing nations are feeling the pain. And I thought it was interesting, one analyst we spoke to talked about small businesses tend to borrow floating rate. I didn't really know that. So they're feeling the pain as well. So it's kind of spattered in different places and different areas around the globe.
Well, and I think, you know, Liz, when we try to figure out the way forward, there's still a fair amount of questions. And even though, right, Jay kind of gave us something to be joyful, it feels like
After today, everyone's on a first-name basis with him.
Exactly. But I do wonder, you know, what problems could be created in developing economies. Like I go back to either like Greece or some different parts of the world where we just saw such problems in specific areas of the world. And I don't know, you talk about some of the areas we should watch. Do we need to be worried that whether it's a developing economy, that there is spillover, that there's contagion? That's always the question.
Right, exactly. So, you know, we have had some defaults in developing economies before, I mean, in this round. And like you said, we lived through the Greek debt crisis. We've had issues already this year in Italy with the ECB having to backstop them. You know, they're always kind of a problem nation in the EU. But yeah, I mean, it's, you know, you start to hear the language of, for like these zombie companies, you know, a lot of my son said, what is that? It's like these businesses that are really kind of churning without a lot of earnings, just enough to service debt, but that are based on rates are low, and they're not so low now. So some of these unknowns, we don't even know where they're going to pop up, and that's the biggest risk. So, maybe we should call him Chairman Powell, as Jim said. Maybe he's going to slow down and take the heat off, but he did make clear that inflation is still their focus number one. So let's hope the inflation numbers around the world keep, looking a little better, and maybe the rate hikes will slow down and these debt servicing costs will ease a little.
Liz, help me out here, because I do feel like when rates were zero or negative or just so low for so long, we thought it was great as companies and even governments like tapping the debt markets to reduce their debt servicing costs. And as a result, it feels like they loaded up also and to create maybe even deeper cushions. And then all of a sudden rates start to go higher, and then here we are today. So how do you think about that? I mean, is that a normal policy and that's to be expected? Because it goes from like things being so good to things maybe not being so good.
Right. And we won't talk politics, but that's part of it is countries need to spend to make, service, the issues in their country, and we didn't want to go into a global depression. But the problem is when we have these crises and we borrow a lot, if we don't whittle down the debt when things are doing better, then that's why, like you see the chart that Ben Holland kindly built for me of all the debt. I mean, it's grown to, nearly 300 trillion globally. And will we get enough chance for people, nations? We haven't had too much fiscal austerity in the U.S. even before the crisis, so I don't know. That's the problem. You could argue we need to spend this money. Maybe companies spend too much. I don't know, but I mean, I think it's a matter of can you whittle it down? Sometimes it's like with a kid, you need some incentive. When I see the rate on my home equity line, I'm like, I don't need to redo my deck. Sometimes it just forces, austerity.
So it brings up the question of geographies, because it's not being treated equally in developed countries versus developing countries. If we take a look at different countries around the world, where specifically do we need to be worried about? Where do policymakers need to be on edge?
Well, I think, and developed nations have talked about they watch it, but developing countries like where they have already defaulted, right? I think Egypt, Pakistan, or maybe at risk of doing it. Sri Lanka already defaulted. So we have organizations that support them, but there's only so much to go around, right? So I think we have to watch out. And like I said, there's certain countries where there was a lot. I was surprised. There's still a lot of floating rate mortgages. Personal.
We talked about this in Canada recently.
Yeah, right. You know that, and. So that stings pretty fast, right?
Yeah. Well, great stuff, and such an important part of the financial markets and how we think about our way forward here. Liz McCormick, chief correspondent for global macro markets at Bloomberg News, as she said, the extent of the damage likely to depend on how high central banks.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed, everybody. Bloomberg Business Week on this Wednesday. Carol Masser, along with Tim Stanovec, we're out on the West Coast and heading out to our plane yesterday off of JFK. We saw all these posters about Avatar.
You gonna go see it?
I never even saw the first one.
Okay, well, it was it's the top grossing movie of all time, okay? So you're kind of the only one. We're gonna have more on that in just a minute. First up, let's get over to Charlie Pellet because we got less than a half hour to go, Charlie.
And I tell you right now, we have got stocks at the best level of the day. Let's get right to the numbers. The Dow now up by 571 points. That is a gain of 1.6%. S&P doing a lot better percentage-wise, up 2.6%, up by 101 points right now to 4,059. NASDAQ, the outperformer, up 3.7%. We've got the NASDAQ Composite Index up right now by 410 points. 10-year yield, 3.68%, with the 2-year yielding 4.37%. Gold up 1.9%, up 1.1% right now at $17.68 the ounce. West Texas Intermediate crude up 3.2%, $80.70 a barrel on WTI. Stocks climbed after Jay Powell signaled a likely slowdown in the pace of tightening as early as December, while indicating more hikes will be needed to curb inflation. Here's Powell speaking live right here on Bloomberg Radio.
The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level.
And again, we've got gold up $19 the ounce to $17.68, up 1.1%. West Texas Intermediate crude up 3.2%, $80.71 a barrel. The man behind the infamous ETF shorting Cathie Wood's flagship strategy is no longer in control of the fund. After splitting from the firm he joined just 7 months ago, Matthew Tuttle's exchange-traded fund lineup, which includes the $344 million AXS Short Innovation Daily ETF, ticker SARK, was acquired by AXS Investments earlier this year as part of the firm's aggressive expansion bid. Right now we have got STARK, that is the short fund, down 7%. Cathie Wood's ARK fund up now by 6.9%. Recapping, we've got a big rally underway, 27 minutes to go with the S&P up 2.6%. And that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So you are listening and watching Bloomberg Business Week. Well, one thing we wanted to get to is a story that's also in Bloomberg Business Week in the upcoming new issue. And what's interesting is this has to do with Avatar, which I think is kind of interesting, Tim, coming off, getting to go into our plane yesterday, right, at JFK.
They're spending money on advertising.
There were tons of posters about the Avatar sequel. And you and I started saying, what?
Oh, yeah, go ahead.
Well, we were saying, wait, is this a Fox movie? Is this a Disney movie? Well, this gets to a story.
It's a little confusing,
yes,
but a lot changed about 3 years ago. Let's get to it with Felix Gillette, media, entertainment, and telecom editor for Bloomberg Business Week. He's also the author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. He joins us live from the Bloomberg Interactive Broker Studio. First of all, Felix, I had no idea until I read your piece that this was the top-grossing movie of all time.
Yep.
I saw it, and I don't even remember what it was about. That's how much of an impact it had on. Why was this movie so hot?
I think part of it was the technology at that point. Everyone was so excited to see it in 3D, and people were making all these grand predictions about there would never be anything except 3D movies in the future based on this movie. That didn't happen.
Totally, yeah.
But people did see it in droves.
One thing I do remember, I'm not joking, the thing I remember about it is I saw it in New York City before I even moved to New York. It was like $25 to see it in 3D and in IMAX. And that was, what, 2009, I think?
Yep, 13 years ago.
So, okay, so fast forward to today. Where are we now?
Yeah, so now this is a big moment for the Avatar franchise. This is the first, if it goes well, James Cameron, the director, has said he's going to make 5 of these. And the Avatar 3 has already been partly shot. Every 2 years there'll be another Avatar sequel. And it's a huge bet for now Disney. The first one was made by Fox, and then since then, Disney has acquired Fox. And it's this crazy moment for Disney where, you know, the share price has been down this year. They just got rid of their former CEO, brought back his predecessor, Bob Iger. Bob Iger is the one who made the deal to acquire Fox, which brought Avatar into the Disney family. So this is a big moment. They spent a huge amount of money. I think $400 million is on the production alone, plus a couple $100 million more to market this. And it better be huge.
Yeah, I was just going to say, let's do some simple math. So if it made about $3 billion back in 2009, Disney paid what, Felix? $71 billion to bring 21st Century Fox into the Magic Kingdom 3 years ago. So what do we got to do? 3 into 71. So we're talking about 20 movies or so.
Yeah,
Am I doing my math
next
right?
40 years to have one of these every 2 years. Yeah, I mean, I think, you know, James Cameron has this incredible track record of movies, blockbusters, Titanic, True Lies, Terminator. So it's always good to bet with James Cameron. You know, this is an odd one because it's unusual for a really successful movie to go 13 years before a sequel comes out. It was delayed several times, COVID, among other things, and there's not a huge amount of, you know, there's no TV shows, there's nothing, there's not a lot of merchandise out there for Avatar, so in some ways it is unusual.
Sorry to jump in. One thing that I'm a little confused about is the relationship between Avatar and Disney pre the assets of 21st Century Fox that were sold, or 20th Century Fox that were sold to Disney.
Yeah, Disney actually made a theme park based on licensing the Avatar IP in Florida, and which is one of the ways that I think that they, you know, wanted to acquire Fox. I mean, it made sense to get Avatar under the Disney roof fully. That park is, you know, still pretty popular, and it's pretty much the existing, you know, you go and see Pandora, which is the moon where Avatar, you know, this world that Avatar brought to life. And I think that's what James Cameron brings.
Don't give it away, Felix.
Yeah.
Carol hasn't seen it yet, okay?
You kind of sound like an Avatar nerd, Felix. I'm just going to say.
It's 9-foot blue people. It's not Smurfs or the small blue people. So that's the, you know, you got to make that first leap. But you know, yeah, it brings this whole world to life. This one is underwater. That's the big new thing that's different from the first one. They've released 3 trailers that look super cool. They invented all sorts of cameras. The cast learned how to do deep diving and hold their breath for minutes. But it's going to be crazy special effects, a big universe.
So maybe Nemo can meet Pandora, like underwater? Is there like, is that where we see the collaboration? Got 10 seconds left. Is this a kind of franchise, though, that they can do parks, they can do merchandising really quickly?
Yes, they want to do it all. They want to expand this thing and expand it, and yeah.
All right, Felix Gillette, Media, Entertainment, and Telecom Editor for Bloomberg Business Week. Also, check out his new book, It's Not TV, The Spectacular Rise, Revolution, and Future of HBO.
We've got a trip. We'll go see the movie together. All right, let's get back to world and national news. We'll take Nancy Lyons along with us. Right now, though, she's in D.C. Hey, Nance.
Thanks, Carol. Congressional leaders are racing the clock to avoid a potential railroad strike. Today, the House passed a measure that would impose a labor agreement that was hammered out in September, but was rejected by 4 of the unions. Senate Majority Leader Chuck Schumer says he feels the time crunch with the strike deadline coming up on December 9th.
We're working hard to get something done and to try to get it done as quickly as possible.
Again, Senator Chuck Schumer, workers want paid sick leave as part of the deal. House Democrats today unanimously elected Hakeem Jeffries to be minority leader in the upcoming session, marking the party's first change in top leadership in 2 decades.
House Democrats fight for the people. That's our story. That's our legacy. That's our values. That's our commitment.
Jeffries will take over as minority leader in January. French President Emmanuel Macron is in the U.S., and President Biden will be welcoming him tomorrow night for the first White House state dinner in more than 3 years.
Emmanuel Macron arrives with grievances. His government is angry about a new U.S. climate law that Europeans say unfairly subsidizes North American electric vehicle production. And France is still stinging over that surprise U.S. and U.K. deal with Australia to build nuclear submarines. Before Thursday's dinner, Macron and President Biden will hold a joint press conference. Today, Vice President Harris will host Macron and his wife on a tour of NASA headquarters and to discuss cooperation on space exploration. In Washington, I'm Amy Morris, Bloomberg Radio.
At the World Cup, 2 games underway. Argentina is leading Poland, Mexico beating Saudi Arabia. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Nancy Lyons.
Thank you so much, Nancy Lyons in our 99.1 newsroom in Washington, D.C. So coming up, we're going to talk with our Annie Massa, who is at a very special event where Sam Bankman-Fried is expected to make some comments later
Expected,
today.
I think, is the key word.
Exactly.
Yes, the New York Times Dealbook Summit.
Which is a big summit. And also at that summit earlier today, BlackRock Chief Executive Larry Fink, who said that most crypto companies will probably fold in the wake of FTX's collapse. And here's the quote, everybody. He said, "I actually believe most of the companies are not going to be around." And keep in mind, BlackRock's had exposure.
Yeah, that's a good point. It's the world's biggest asset manager. It is among financial firms that were stung by the bankruptcy of the Bahamas-based crypto exchange founded by Sam Bankman-Fried, a.k.a. SBF. As you mentioned, Carol, he's scheduled to speak at Dealbook Summit later today. BlackRock oversees about $8 trillion in under management. It invested roughly $24 million in FTX through a vehicle called a fund of funds, said Fink, who is a longtime skeptic of cryptocurrencies. $24 million for BlackRock is like,
It's small.
That's tiny.
And mind you, Tim and I have had a lot of conversations. We've moderated panels when it comes to crypto, the crypto world and all its glory and all of its, concerns. And a lot of the establishment within the financial community has talked about, certainly tiptoeing in, having some, relationships or working with others in the crypto world because they're just trying to figure out kind of where it goes. I will say Larry Fink of BlackRock did go on to say he still sees potential in the technology underlying crypto, including instant settlement of securities and simplified shareholder voting. This is, I think, going to blockchain, which I know you're like,
it is,
always...
but what does that do for the price of, Bitcoin and Ether? Right?
But again,
if it's
what
technology that people are saying is the future?
What
does it do to the currencies that what the majority of people who own them now bought at a higher level than they are right now?
Which I think goes to that original question, exactly what are cryptocurrencies? Are they really currencies? Are they a collectible? How should we view them?
If you haven't already, check out the Bloomberg Business Week magazine takeover, Matt Levine's last month, What is Crypto edition of Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Powell speaks. Markets respond with a roar, with the Dow, the S&P, and NASDAQ all at or near best level of the day. We've got 13 minutes to go ahead of the close. Right now, the Dow is up 577 points. That is a gain of just about 1.7%. The S&P up 105 now, higher by 2.6%. NASDAQ, the outperformer by far. The NASDAQ Composite Index up 422 points, up now by 3.9%. The NASDAQ 100 Index up by 4%. Big tech surging. Apple, case in point, up now by 4.5%. Amazon up by 4%. Meta Platforms rallying 7.4%. And Alphabet, parent of Google, up now by 5.5%. 10-year yield 3.68%, with the 2-year yield 4.36%. Spot gold up 1.1%, $17.69 the ounce. A Bitcoin right now is up 3.5%, 17,041, while West Texas Intermediate crude oil is up 3%, $80.58 a barrel. So again, recapping, a major rally underway on this Fed Wednesday. S&P 500 index up now by 2.7%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 12 minutes to go, just under, until we get to that closing bell. We'll talk with our TV colleagues for our simulcast coverage. But in the meantime, stocks, as you just heard from Charlie, they're holding on to their best levels. We've got quite a rally underway as stocks have come roaring back following Jay Powell's comments. And we've seen yields which backed off as a result of potentially maybe an easing in terms of the size of those rate increases. We've seen yields come down significantly.
Let's see what Nicole Webb has to say. She's Senior Vice President and a Financial Advisor at the Wealth Enhancement Group. She joins us live from our Bloomberg Interactive Brokers studio in New York. Nicole, good to see you. Good to hear you this afternoon. How are you?
I'm doing well. How are you?
We're doing pretty well. I mean, the equity markets are doing really well today off of those comments from Fed Chair Jay Powell a little earlier today. How are you reading into his commentary? Is the market getting a little ahead of itself?
You know, it's really interesting. I actually, our firm had anticipated that there was perhaps a bit of a validity rally come the December announcement if we do get the 50 basis points that people believe have been already embedded into the stock market. I think his sentiment today was perhaps that validation that the tapering, the slowdown of the rate increases was to be expected. And so I do think some of that is playing out in today's market here, the second half of the day.
But is it warranted?
I am part of the consensus here. From our best estimates, what we're seeing is that when supply chain fully normalizes, we expect inflation to sit around 4%. And the amount of demand destruction necessary to get down to that 2% target suggests that rates will have to either go above 5 or that higher terminal rate will have to last a bit longer. And we do think that that could impose a bit of an earnings shock.
All right, so that leads me to a question, Nicole, that a higher rate environment, right, you get to find out which companies are really resilient and set for the long term and which are not, and that speaks to what we'll see in earnings. So when you think about that, what kind of companies, what kind of sectors would you expect, or what kind of balance sheets should investors be looking at right now to maybe commit some new money?
Yeah, the end of today's trading day is interesting, and one point that we've seen play out actually this week consistently is that I wouldn't say that some of these names are necessarily a shift in trends. So when we think about duration assets kind of popping here at the end of the day, the technology firms, we're not ready to go back that way. This seems to be a bit of maybe a rearranging before year end, where we're still looking at some of those revenue stability firms coming into the new year. So one specific name that comes to mind is Costco. We love the membership fees. They don't carry many SKUs, so they carry a strong competitive edge there. and they really have a long track record of earnings per share growth that we like.
Okay, before we get to some other picks, I just want to go back to your commentary about where we are in the market right now. So if you're saying that rates are going to have to go above 5 or that we'll see a higher terminal rate for longer to try to bring inflation down below what you see as 4% after supply chains do normalize, what does that mean for where the S&P 500 goes in 2023? I guess the question that I'm asking is are we off of the lows of, I don't want to say the year, but of this cycle?
Yeah. With some confidence, we would say that the trading range next year is a bit narrow. So you have this convergence of two themes that generally carry their own kind of predominant thematic trading. Those two themes being in a stall out of a higher terminal rate. So one, the compression to earnings there. But then secondly, markets tend to do quite well in a disinflation environment. And so as you continue to navigate those two against one another, our best guess is that the market does trade in this tight range with suppressed earnings, but we too are a bit in the camp of it doesn't have to be a catastrophe. And Powell, shared those same sentiments today.
I love that you come, though, with company names and stocks. So I want to go back there.
Yeah.
You mentioned Costco, and that makes sense to me. TJX is another one, which we know people love the bargain hunt, right, at TJX. We know their latest earnings, it wasn't so much about the home anymore and their home goods component, but about apparel and other areas. They showed some strong results.
Yeah, and we've been a bit dismissive of retailers this year, certainly, but we love TJ Maxx. And look, we don't believe that a disinflation environment means that inflation is going away across the board. We know that we have some threats to energy costs. We have looming inflation that will be a bit persistent. And so you couple that with, TJ's bargain hunting, but then also inventory excess. We know it exists. It's coming to them cheaply. And then also you have freight and transportation costs coming down, all helpful to their bottom line.
What else do you have your eye on? What else are you bullish on?
Wait, let's talk Amazon.
You
You like Amazon?
I do like Amazon. This isn't one where I would say, if you're managing a P&L day to day, it's probably not helpful. But looking out into 2024, we expect that, it's going to start to shine again for a lot of reasons. But their management is highly focused on free cash flow. They seem to be investing in the right areas. They're responding to trends and themes around them. Their excess inventory, they really doubled down on what they were able to fulfill during COVID. And so that's hurt them a little bit on the backside. But again, they too will be helped over the last couple of quarters with shipping and freight costs coming down as well.
Do you think we see Jeff Bezos pull a Bob Iger or Howard Schultz and
A
come
little
back?
bit of a boomerang. I love a boomerang CEO story. My favorite is Starbucks and now maybe Disney. Yes, I actually do. I think
Really?
hindsight is a little bit 20/20, and sometimes I think when someone steps away, I think about Bob Iger in this way. He did not invest in DTC or the direct-to-consumer business, and probably now has spent a good amount of time focusing on those coulda, woulda, shouldas, and comes refreshed and able to perhaps maneuver with more clarity. I think Bezos might be able to bring that to the table. I don't know. It's just a thought.
All right, just got about 20 seconds left here. Real quick on Apple and why you think it's something to buy right now.
Consistently, it proves to be shareholder friendly in terms of the way that it focuses on its stock buyback program. I think that's interesting for retail investors to focus on, and it's highly efficient. Its return on invested capital continues to prevail. They're just a great company overall.
All right, we're going to leave it on that note. Really some great companies to think about, certainly in this environment. And it's safe to say that I think all of these names, because pretty much everything seems to be rallied coming off of the comments from Jay Powell. Nicole Webb, thank you so much. She's Senior Vice President, Financial Advisor at the registered investment advisory firm Wealth Enhancement, joining us back in our Bloomberg Interactive Broker Studio. That's, of course, in our New York City headquarters. Carol Master, though, Tim Stanovic, we're live here on the West Coast at our San Francisco Bureau, watching the markets, that rally holding, rates staying lower. We're going to head over to our TV colleagues shortly, talk about the markets. You are listening and watching Bloomberg Business Week on Bloomberg Radio.
It is 3:57 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. This past weekend, protesters across China took to the streets to demand an end to the government's draconian COVID-0 policies. Remarkably, some called for President Xi Jinping himself to step down. Although heavy policing has discouraged further demonstrations, the fact that factory workers, students, and urban professionals united around a single demand should worry authorities. Chinese leaders' top priority right now should be reopening safely. That means officials must present a more realistic picture of the coronavirus's risks, and Xi will need to set the tone if the shift is to be convincing. At last month's Communist Party Congress, Xi was hailed as the country's new helmsman, an honorific previously reserved for Mao Zedong. He should now show that he knows how to change course. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion. Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic and Scarlet Fu, we're counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, as well as on YouTube and on Quick Take. Carol, this is the time where we normally parse the most crucial moments of the day. Pick one crucial moment of today.
It's the J Day.
Oh, I thought you were going to say CrowdStrike earnings. Okay.
I mean, think about how the narrative has changed in the markets. I mean, what a risk-on trade today. And we're talking about the S&P headed for its longest monthly winning streak since August of 2019. We're looking at the Dow, maybe a new bull market. I know you don't love the Dow maybe as an indicator, Romaine, but, I do wonder about technicals, what kind of new technical levels we might be taking out because of this move up in stocks.
I will say though, real quick, Jim, about the Dow and Dow Transports. I mean, they've really been leading the charge really over the last month and a half or so, and I wonder what that says about investor sentiment.
Well, we just had a market guest who said one of the reasons that they like some of the retail sectors was that Amazon specifically talking about, that freight costs and things are coming down and that you're going to see companies benefit as a result of that.
That was Nicole Webb, Senior Vice President and Financial Advisors at the Wealth Enhancement Group. And Scarlett, we talked to her about what things are going to look like next year and what she's predicting. She thinks that we're going to see rates go to above 5, or that a higher terminal rate will have to go for longer, and that could lead to an earnings shock. But she said that the market's going to trade in a somewhat tight range with these suppressed earnings. But I got to throw a curveball here, because the most interesting thing that I thought I heard from her was a prediction that Jeff Bezos is going to come back as the CEO of Amazon. That's the prediction that she has. Yeah, she said, I love a boomerang CEO. Howard Schultz, Bob Iger. She says she thinks they're going to see it with Amazon.
What's old is new again.
Yeah, why not?
Exactly.
Everyone just come on back. All right, let's walk you through the numbers here. We do have a lot to parse. The Dow Jones Industrial Average higher by about 700 points, or about 2% here on the day. The S&P is going to finish higher by about 3% on the day, back above that 4,000 level, and more importantly, at 4,079 and change, back above its 200-day moving average. The NASDAQ Composite higher by 4.4%, 484 points added to that here on the day, and the Russell 2000 not sitting out either, up about 2.7%. And I should just point out, Carol, here, on a monthly basis, pretty strong gains across the board. I won't go through all the numbers, but roughly about 4 to 5% across the boards on a monthly basis, and that's actually setting us up for a 2-month gain right now for most of these indices and average, now in the double-digit percentages, and I'm talking like 13, 14, and in the case of the Dow, 20% gains. So if this actually sustains itself through December, this is going to end up being one of the best quarters for equities that we've seen in years.
Yeah. Jay Powell may have not said pivot, but it does feel like there's a bit of a pivot in investor sentiment. Here's something I want to just, layer on. Look at Meta today. It's up almost 8% in today's session. We know it's been beaten down this year, but I do feel like, Scarlett, it speaks to investors willing to kind of wade in on almost every name that's out there, despite questions about the future.
And sorry, Scarlett, just one other quick superlative. The Dow Jones Industrial Average did close up by about 20% off of that low that was set back on September 30th, up 20.4% if you want to be exact. So at least on a technical level, Scarlett, now flipping into a bull market.
Okay, Romaine, there's some love for the Dow from you.
Well, I wouldn't say it's love. It's more just, pointing out the facts.
Begrudging acceptance. How about that?
Thank you. Scarlett.
Sorry, Scarlett.
Yeah.
All right, you talk about the technical bull market and the Dow Jones Industrial Average. You look at the S&P 500, green across the board here. As we look at the 24 industry groups, and Carol, you mentioned Meta. That shows up here in media and entertainment, and of course, the communications and professional services. Like, basically, a lot of the beaten down big cap stocks are all reflected here with gains of better than 4%.
All right, so let's get to some of the gainers, folks. There was a lot to choose from, and it certainly changed in terms of the top performers in the major indexes as a result of Jay Powell's comments. But Estee Lauder, #1 in the S&P 500 today, best performing stock in that major index. As some parts of China, where the company typically generates around 1/3 of its revenue, ease COVID-19 restrictions. So we saw some enthusiasm over that name. Intuit, also a top gainer in today's session. You can see that stock up more than 7%. That company coming out reaffirming its profit forecast for next year, 2023, and that overshadowed its reduced revenue view. It was all about the outlook for that company. And then Woof, we're talking about Petco, health and wellness, soaring. It was up more than 17% at its highs today, finishing the day with a gain of more than 16%. Reported comp sales for the third quarter that topped the average analyst estimate. It did trim its adjusted earnings per share view for the year, but it did reiterate its outlook for a net revenue. So, man, some big outperformance, Tim.
Okay, a lot of green on the screen, but it wasn't actually too difficult to find some underperformance. We look no further than cloud stocks, cybersecurity stocks today, specifically CrowdStrike Holdings, finishing it down by 14.75%. We can go ahead and round that up to 15%. It gave a revenue outlook for the current period that fell short of estimates. We saw other decliners in the space as well move lower as a result: SentinelOne, Zscaler, Palo Alto Networks, and more. And then NetApp finishing it down by about 5.8% today. It's a storage and data management company. Adjusted EPS for the third quarter missed the average analyst estimate, as did net revenue. So we saw shares move lower. And then Hormel Foods dragging down the S&P 500 today, or weighing on it, I should say, down 2.5%. Its fiscal 2023 forecast for net sales and earnings per share missed the average analyst estimate. You know Hormel, they make Spam, they make Skippy peanut butter, and more. They saw, interestingly enough, particularly weakness in the area of Turkey as a result of the outbreak of avian flu, Romain.
Yeah, and we're going to get to yields in a second. I do want to point out to folks, Salesforce earnings are crossing the wire here. Just going to give you the top and bottom line numbers here. On a basis, it does look, at least with regards to the fiscal 3Q numbers, sales coming in at $1.7 billion. That's pretty much in line with what the street was looking for, and the company's sticking by its full-year revenue forecast for about $30.1